and welcome to the next installment of the Private Equity Executive webinar series. The topic today is navigating GovCon M&A for private equity sponsors. My name is Catherine Hickey. I'm a member in McDonald Hopkins Business Department and part of the firm's Mergers and Acquisitions practice group. Joining me today are Kevin DeSanto, Managing Director at Kipps DeSanto and Company, and my colleague David Schaefer, member of the McDonald Hopkins Business Department and also part of the firm's Mergers and Acquisitions group. Today, we plan to touch on a number of topics relating to government contracting M&A considerations with a specific focus on private equity sponsors in the space. We're going to touch on transaction structuring, nuances of deals in this industry, such as contract novation and recertification, business valuation approaches, unique diligence considerations in the GovCon industry, small business affiliation issues for transactions involving small business government contractors, and other topics such as government intellectual property rights, other diligence issues, and current market trends for M&A in the industry. We would be happy to answer any questions from the audience during this program, and you can submit your questions at any time during the webinar by entering them in the control panel of the webinar or by emailing events@mcdonaldhopkins.com. If you submitted questions in advance of the program today, we will also try to cover those during our discussion. If we don't get to all the questions, we can always follow up via email to make sure that everybody gets responses to the content that they want to address. So we have a lot to cover today. We can go ahead and get started. As an overview of the high-level topics we want to address today, we will be providing first a government contracting market overview, examining some of the features of the market that make it attractive for private equity firms looking to conduct M&A activity in the space. We'll also talk about some of the unique opportunities that government contracting target acquisitions can present for private equity funds. We'll talk about specific transaction structuring considerations to bring into the discussion as you are putting your deal structure together. We'll address particular diligence issues that arise for GovCon M&A transactions that may not be an issue in other commercial industries. And we will talk about small business affiliation concerns, which in and of itself could be its own webinar, but something to be aware of if you are going to be navigating in this space. So we'll touch on it briefly today. And we can move on to the next slide and start with some of the market overview. The government contracting industry presents a lot of opportunity for stability and long-term revenue predictability and steady growth for investors in the market. It has been a field in which there has been long-term sustained, stable, and predictable market growth. And a lot of that is generated by the fact that there is a very large end customer in the federal government, and that's even setting aside state and local governments as well, with needs that the way that the government structures its own internal workforce are pushing services and contracts more and more out to the contractor market and putting, again, a steady flow of revenue from a reliable payer out into privately held companies and presents an opportunity for funds and sponsors who want to enter into the market and participate in, some of that nice, stable, sustained growth. Historically, the government contracting industry has proved relatively recession resistant in that it's insulated from broader commercial market pressures in many regards. Again, the end customer is the federal government. Contracts are typically going to be reliably paid in full unless there's some sort of broader reason to renegotiate price or budgetary issues. But for the most part, you're not going to be in a situation where you're dealing with an end customer that itself is going to face solvency issues, cash crunch issues, and isn't going to be able to pay your invoices. The market then is, while it's less volatile than you might see out in the commercial world. The business models for many government contracting companies tends to be very capital efficient. A lot of government contractors, although not exclusively, are based around provision of services. They tend to be low overhead companies, very efficient from a capital expenditure perspective. And especially now where much of the workforce can be handled remotely for a lot of these service providers, really cutting down on larger spend issues such as, real property leases, equipment leases, and maintaining, manufacturing facilities and things of that nature. Now, that obviously does exist for some government contractors who are more in the provision of goods to the government, but the vast majority of contracting firms are services focused. We've seen over the course of the past decade, at least, a very consistent and active M&A market. There are a lot of both strategic large contractors that have grown and continue to grow via acquisition, as well as more and more private equity fund sponsors building out portfolios that have a focus on the government contracting industry because of some of these attractive market features. Some of the drivers that have driven this long-term market demand in M&A activity is that, as I briefly mentioned earlier, the federal government continues an ongoing trend of outsourcing workforce needs. So rather than adding to direct federal government employees, more and more programs are being staffed primarily with government contractors who fill out those seats and provide those services to the government. This means that private companies have the opportunity to participate in, the vast services needs of the government on an ever increasing basis. Also, in the past decade or so, the drive towards IT modernization is an ongoing effort at the federal government level that is getting a significant amount of investment and that still has a significant way to go. So this creates opportunities for many IT government service providers to improve and maintain and continuously strengthen government operating systems. So you think about things like cloud migration, cybersecurity issues, all of those platforms at the government level, which are vast, need to be continuously monitored, updated, and maintained, which creates a lot of opportunity for IT service providers to the federal government. We can move on to the next slide. Some additional features of the market to consider as you're looking at evaluating, what features of it might make it an attractive area to venture out into for a fund investment. Contracts at the government level, federal government level, tend to be long-term and have priced out allocated funding for the length of that contract. So they tend to be 3, 5 to 7 years in length. And that builds out a very nice backlog of contract revenue that once those contracts have been awarded, a customer or a client can put onto their backlog, a government contractor can put onto their backlog and predict out, here's our projected revenues for the terms of those contracts with a very high degree of certainty. The types of pricing models that we typically see, the most common pricing models for these contracts are firm fixed price contracts, time and materials contracts, and cost plus contracts. As you're doing contract diligence of a potential target, it's important to understand what these models mean and different types of risks that they might present. Firm fixed price is obviously the most predictable. You quote a price for a certain project to the government. If it's accepted, that's the price that's paid. You have a wide degree of flexibility in terms of how you hit that target, and then the profit margin that you're able to create within that price is up to you. Time and materials consists of passing through charges to the government. That comes with a higher level of accounting oversight and compliance, which we'll touch on a little bit later on. And then there are cost plus contracts, which is you charge the cost of the services plus some agreed upon profit margin that also comes with a higher level of accounting compliance and oversight, which we'll touch on. The EBITDA margins for most mature companies in the space tends to be in the 5 to 15% range. There tends to be a very strong cash flow in these companies because, as I mentioned earlier, for most of them that focus on services, they have very low capital expenditure requirements. So they tend to be very cash-rich enterprises. Another feature of the industry that can be attractive for the players who are already established in the space is that the federal contracting rules and regulations provide a pretty significant barrier to entry for new competitors who would get in into the space and start to decrease market share. In order to receive a direct prime grant of a federal contract, a contractor has to establish past performance, which requires time and previous experience on contracts, usually at a subcontractor level. And that takes years to build unless it's acquired via acquisition. So that high barrier to entry is a very attractive feature for those companies that are well established, that have contracts, have relationships with customers, and if all continues to go well, that is likely to continue and grow. Majority of the companies and customers based in this market are in the DC metropolitan area, so Northern Virginia, Washington, DC, Maryland, although there are a significant concentrations of government contractors in various other locations around the country, typically near bases and other agency establishments. So we do see other pockets pop up in various locations nationwide. Next slide. I'm going to pass it over now to Kevin DeSanto of Kipps DeSanto and Company to give a little bit of context over the market trends more generally and talk to us about where we see things headed for 2023.
Thanks, Catherine. I wouldn't have known you were a lawyer based on all of that business perspective that you just gave to us. So I appreciate that. So
thank you.
It lays some good groundwork for this conversation. For those that don't know me or Kipps DeSanto, we're an investment bank that focuses on M&A and financing transactions across aerospace, defense, government, and technology industries. Based in Tysons Corner, Virginia, and work on about 20 to 25 typically sell-side engagements on behalf of our clients in those sectors. And so, my job and opportunity here over the next few minutes is to give some perspective on what we're seeing, particularly as it comes to mergers and acquisitions in the government contracting space, and a little bit of background on why we think it's happening, what we think is going to be part of future activity in the marketplace, and then ultimately just some of the things to think about in the context of your own strategies, whether you're building a business or looking to do acquisitions or partnering with private equity as we go through and kind of execute on business strategies here. I guess the first thing I wanted to do is just really level set on M&A activity in government contracting. I think depending on where you live and kind of what your focus areas are, it can feel like deals are happening every day in the space. Generally it's a pretty close community and sort of markets and the DC area proper having a large concentration of these types of businesses, and so it can feel like it's a constant barrage of M&A activity. The reality is that it's a relatively small percentage of companies in the government contracting space that end up transacting. If there's some metrics put the total government contracting space at 115,000 or so companies. You'll see on this chart that roughly 100 to 150 companies are transacting each year. So it's a relatively small percentage of the overall industry, but something that does feel pretty prominent relative to strategies and how people think about growing their businesses. The other piece of this is you'll see that we've broken down the industry for purposes of talking about mergers and acquisitions into 4 separate buckets. Private companies, so those that are doing deals on their own, typically with a bank as a partner for financing those types of transactions. Publicly traded companies, which are the the larger businesses that are traded on the New York Stock Exchange or the NASDAQ or other kind of public forums. Financial sponsors, which is when a private equity group or an institutional investor is buying into an existing industry company. And then portco, which is when the private equity firm is investing in a company, and then that company is ultimately going off and doing additional acquisitions. And so from our vantage point, that's really a helpful way to look at what's happening in this industry. And what Catherine talked about is why a lot of people are interested in buying or investing in these types of businesses. Strong cash flow, strong growth, lots of visibility given the customer base. From a competitive dynamic, there's certain things that you can benefit from, or certain things that help restrict competition, depending on the customer and the situation that you're in. So there's lots of really unique aspects to these businesses that lead to strong interest from buyers and investors. When we look at and think about the activity of the last 5 to 10 years, there's really a lot of unique and interesting things that are happening and have happened during this time. I think one of them is really, if you look at this chart and kind of deduce what's occurred, the number of transactions has basically doubled over the course of the last 10 years. There's, again, a number of different drivers for that, but one of the primary factors is that private equity, the financial sponsor in the terminology that's on the slide, has become one of the most active buyers or active groups of buyers that are driving M&A activity. And so when you look at the numbers going back into 2014-15 timeframe, roughly 25% of the M&A activity was driven by private equity. We see that number today being upwards of 65 to 70% of the activity in 22 and 23. And I think ultimately, if you include the seller activity in these numbers, you're probably looking at somewhere between 2/3 and 3/4, maybe 80% of deals having a significant impact or significant relationship to private equity. So it's become a very, very common part of the industry and something that has helped increase the level of M&A activity in a pretty material way. When we look at the types of businesses that private equity investors really favor, they tend to be businesses that are reflective of some of the things that Catherine talked about. Higher margin businesses, higher growth businesses, businesses that have a diversified customer base that allows for them to run and operate irrespective of the swings that may occur from a budget or from a political administration. Companies that can survive economic downturns. One of the famous and more popular things to say about the government contracting space is that it is resilient, or that it is countercyclical, or in today's world that we think it's going to prove out to be recession proof. And while that's not the case for every business or every sector, and certainly probably not across the board in government contracting, the dynamics of these businesses really support very strong, consistent, visible growth, opportunities to continue to grow. And then I would say maybe the biggest factor from a private equity vantage point is that these types of businesses lend themselves to a value arbitrage or a valuation multiple arbitrage that occurs with scale. And so by virtue of just how businesses are built in this sector, when you have businesses that might have $5 to $10 million of earnings or cash flow versus businesses that have 30 to 40 or 40 to $50 million of cash flow, there's a significant increase in the relative value of the larger organization because it's typically a lower risk profile. There's fewer issues that can really damage the entity in a material way. it typically has greater growth opportunities, the ability to bid on or win larger contracts, or the ability to bid on and win more contracts when it comes to the infrastructure and things that you can build at a larger organizational size. And then I would say the third piece is really that these are very strong cash flow businesses that support financing that can make the transaction structure something that works out exceptionally well for an investor. And so anybody that's been through a finance class in a college or a university, and you think about the efficiencies of the capital structure, the more you can borrow to fund and finance the business, the more efficient it is from an equity return vantage point. And that's something that we see really playing out in a very, very significant way in this sector. And so when you look at and think about the numbers and the things that have happened here, it really is, as investors have found the space, as they've grown accustomed to the types of businesses that are available, and then the strategy of not necessarily a roll up in the traditional sense, but really increasing the size and the scale of the business through acquisition is something that's played out very significantly here over the last 5 to 10 years. The other thing that I just want to quickly address on this slide before we flip to the next one is the peak valuation or the peak M&A activity that occurred in 2021. As everybody is aware, these have been, kind of 3 or 4 crazy years in terms of the world as we know it. Hate to kind of go back and reflect on the pandemic and the issues that we began to experience in February and March of 2020. But I do think it says a lot about this industry. A lot of industries really struggled through the course of 2020 and 2021. We actually saw increased activity, increased investor interest in this space in what was probably one of the more complicated, more complex, more dynamic environments that we'll ever see as business leaders in that 2020 and 2021 timeframe. These businesses adjusted exceptionally well, they performed exceptionally well, and they were very consistent through that timeframe. And so we saw a major increase in M&A activity in 2020 and 21, which was, I think, generally unpredictable at the time. But in hindsight, it's really a great chance for folks to create value, to start to build platforms, to add to platforms that they already have. And a large part of that was that it continued to be a business and an industry with great visibility. And so when you look at some other sectors and sort of the unknowns coming out of a pandemic type environment, work from home, staying out of bars or restaurants or hotels or travel, things like that, these businesses prove to be very resilient, and just another reason for folks to get excited about being investors in this space. I doubt, and maybe I'll live to regret this, but I doubt that we'll ever see volume of activity similar to what we saw in 2021. A very unique confluence of events in terms of kind of where the economy was, where the funding environment was with lower interest rates and lots of capital availability on both the debt and equity side. It would seem hard to ever get back to that time. And in some ways, we may not be able to support that amount of activity because the number of companies that was acquired really reduced the number of what I would characterize as high quality companies that exist in the sector today, in that range of size or kind of scope or shape that would be relevant for M&A activity today. So it's going to take a few years to grow back that part of the industry that's been gobbled up here over the last couple of years. I'm going to flip over to another page here and just kind of break down the private equity activity just in a little bit more detail, so folks kind of have this as a backdrop. Again, this is that sort of the terminology here where we use Portco as the sort of private equity backed platform on the previous page. Platform represents that here in this analysis. So the blue bars are the number of new platforms that were established in each of the years between 2017 and year to date 2023. And you'll see that we're averaging roughly 20 new platforms in the GovCon sector each year. So new, not necessarily a new private equity group, but a private equity group coming in and setting up a new platform, buying a business to be kind of the catalyst for future growth opportunities. Over that same time period, you'll see that we've seen roughly 10 to 12 of those platform companies that have been sold. And so on a net basis, we've been increasing the number of companies that are private equity backed in the sector on a year-over-year basis for the last 5 to 6 years. That's really an important factor because ultimately the number of private equity platforms that exist is really a significant driver in overall M&A activity. You'll see the gray dots that are above the bar charts there. That represents the number of transactions that each of those portfolio companies or each of those platform companies is conducting each year. So you'll see on kind of the statistics there, roughly 30 additional M&A transactions are driven by the roughly 20 new companies that are coming into the sector or platforms that exist each year. And so it's a super kind of dynamic environment where you not only create the platform, but you ultimately then yield 2 to 5 additional transactions over the next 3 to 5 years for each of those platform companies. That again is one of those big drivers of that doubling of overall volume that we've seen in the kind of overall stats that we talked about on that previous page. So we anticipate that, given the dynamics in the industry and given the kind of favorable experience that many investors have had, that there are a number of private equity groups that are out there. The numbers probably historically might have been 10 or 15 funds or groups that are interested in the space. It's triple, quadruple that today in terms of the opportunities that we see for private equity folks looking to get into the GovCon space. So we think there's going to continue to be activity where the private equity investors are interested in getting in. We believe that will continue to drive add-on acquisitions for each of those organizations to grow not only organically, but through acquisition. And then we also believe that that's going to be a significant driver of the activity at the public companies or the larger private companies that are looking to grow through acquisition as well. And when you look at the previous page and the stats that were there, you'll see that roughly 20 to 25% of the deals that get done each year are done by public companies. That's really a unique stat in this sector. Typically, you would think that M&A activity would ultimately be driven by the public companies, given they're larger, well-capitalized. There's typically significant public companies in the market. But what has happened is, we continue to have M&A activity amongst the public companies. And so you'll see in any given year, there's 10 to 12 really relevant public companies in the government contracting space. They're each doing a deal or two per year and creating, volume of activity that makes up about a quarter of the overall M&A activity that we see, which leaves a ton of opportunity for private equity investors to be acquiring businesses and building up businesses that are ultimately very interesting to those public companies. And in general, the size of the public companies has increased dramatically over the last few years and put us in a position where they are looking to do ever and more large transactions. And so the private equity consolidation, the ability to build these platform companies up into that 30, 40, $50 million of earnings that I characterized before has become a great source of creating value for those large public companies. And so it's a nice ecosystem that tends to take smaller assets, consolidate them into something larger, and then turn it into an asset that's attractive to the public companies. And it creates an ecosystem for investors and owners of businesses to realize liquidity, irrespective of kind of where you are in that life cycle. Lastly, and before I turn it over to Dave, I just wanted to highlight a few of the things that we look at and think about as it comes to M&A activity and really the interest in private equity in the sector. We talked about some of the company attributes, some of the things that really drive the market from kind of an M&A vantage point. One is, I would say, and I'll probably combine this into one comment, but it's really sort of the political environment in the US and then the geopolitical environment across the globe and the interplay there. as I'm sure most people can appreciate over the last couple of years, and really since early 2022, with what has transpired between Russia and Eastern Europe and Ukraine, there's been a significant impact to the M&A environment over that period of time. A lot of interest in companies that are supporting defense or intelligence organizations, been a very significant pickup on that. And in particular, that's of note because you would anticipate that in an environment where you have a presidential administration that is, Democrat, you might see different spending initiatives or priorities in that type of government setting. And we've really seen very balanced kind of interest on the M&A side here, because I think folks feel like the budget in all categories is really trending in the right direction here today. So political budget has an impact on things in the M&A market. The second part of it is really what the kind of broader economic backdrop is. And obviously things are complicated in today's world, and there's lots of things that are happening and driving the markets up or down here in what feels like a whipsaw fashion. But the thing that's really most important for us, for these types of businesses, is the availability of capital. And we see a tremendous amount of private equity capital interested in the space. And we also see that there are lots of debt funding sources that exist for the space today as well. Interest rates have increased, the cost of capital has increased naturally as an extension of that. And so, we're seeing changes to the environment, but the businesses in this sector tend to be those that can still attract capital in the current environment. And then the last piece of it is really, sort of what it takes to run these businesses. And everybody's heard and seen a lot around supply chain and a lot around labor costs and lots of other factors that are making it harder to run businesses. What we see in the sector is that, ultimately, folks are figuring out how to operate in this sort of new world order, that they're able to drive growth in their businesses. And that's really the buzzword or the term that I think is most important in all of this is if you can figure out how to grow your business, irrespective of what's happening in the broader economy or the geopolitical or political environments, that there's a ton of interest and there's a ton of demand for these types of assets. And so as we think about advising companies, one of the big factors is what's the right timing to go to market or to have these types of conversations with a prospective investor. And I would say the ability to grow, the ability to figure out those business challenges and really drive your business from a revenue and earnings vantage point is going to make you a very attractive asset. And if you're an investor, it typically is the one thing that folks kind of focus on with us is, wanting to buy businesses that are performing, that are, really in a strong position today. And lots of opportunities in the large market that Catherine described for that to be the case. So, exciting times for different reasons than the last few years. They've all kind of had their own unique personality to them, and I think everybody's really adjusting to the environment that we're in, and expect to continue to see a lot of activity and a lot of conversations around acquisitions and bringing capital and particularly private equity capital to build and grow businesses. So with that, I'll turn it over to Dave and discussion around some of the other kind of components and aspects of the M&A transaction.
Yeah, thank you so much, Kevin. I appreciate that. And I think this is a good opportunity to kind of build upon what you were just discussing, these value drivers, certain aspects of the government contracting industry that portcos, platform companies that use the term that you like, but the private equity-backed entities can use to generate, additional top-line revenue, additional value, access to different agencies or other companies that don't otherwise exist kind of in the commercial marketplace. So these are some of the things that we've seen a lot of clients use to leverage and grow their business, organically, in addition to those kind of inorganic growth that was just touched upon. And I think it also addresses some of the things that Catherine was talking about with regards to the barrier to entry. And these are some mechanisms in order to gain entry into, certain components of the federal government contracting landscape that you might not otherwise be able to due to size of the company, affiliation concerns, or other regulatory requirements. So we're just going to touch briefly on some of these, mechanisms in which you can, grow your portco and ultimately, derive additional value. And one of those is joint ventures. And joint ventures takes on a little bit of a different flavor in the government contracting space because it is regulated to some extent. But a JV is a great opportunity to be able to find those qualifications and leverage the past performance of your co-venturing partner in order to bid on contracts which you may not otherwise have the quals or the past performance to do so. And the work share and equity component aspects do not necessarily have to be in parallel. So there's a good opportunity to derive additional value as well from work share or from kind of an equity transactional component of that JV. And that really feeds into this concept of a mentor protege. So there's a mentor protege program. There's actually two. There's one run by the Department of Defense, and then there's one run by the Small Business Administration, which had consolidated prior variations of the mentor protege. And the mentor protege program is designed for mentors, large businesses, portfolio companies typically, or large publicly traded companies, to provide mentorship and guidance to small businesses in order to help the small businesses grow. And in so doing, there are certain incentives that the Small Business Administration has put in place, such to incentivize large and other than small businesses to invest and to participate in this program. And one of those is an exemption from the automatic determinant of affiliation. And Catherine's going to talk about affiliation at the end, but suffice it to say that there are certain aspects of a company in which you want to make sure that you are not affiliated kind of in a legal sense in order to bid for contracts that are otherwise set aside for small businesses. But through the mentor protege program, a large business could team and joint venture with a small business, leverage that small business's set aside status, which I'll talk about in a moment, in order to bid for a contract that might not otherwise be able to obtain, while also getting 40% in that JV, or I'm sorry, 40% in the protege and 49% in the JV, with an increase of work share. So there's various different mechanisms and levers to pull that you can effectively partner with a small business, use their set aside status, use their past performance, use their qualifications to drive more revenue and value to your entity while still maintaining compliance with small business regulations. And so in that sense, and switching to the Small Business Administration considerations here, it's important to note that the federal government sets aside a significant portion of government contracting spending dollars every year to support certain small businesses in various different categories, specifically veteran-owned small business, service-disabled veteran-owned small business, women-owned small business, economically disadvantaged women-owned small business, an 8A disadvantage program, and a hub zone program as well, where companies that qualify for those various set-aside status are able to bid on contracts that large businesses are not otherwise able to bid on. But through the mentor protege, through the JV, you're able to style such that you could take advantage of those opportunities to the extent that your protege otherwise qualified for those opportunities. And related to that, when we talk about tribally owned entities, we talk about Alaska Native corporations, we talk about Native Hawaiian organizations, there are also additional regulations that permit them to have additional, say, 8A small business entities, provided that they are not within the same NAICS code or same line of business. So they tend to prove to be excellent partners for accessing new markets, for driving some additional growth, for partnering on bids and proposals to access certain things that you might not otherwise do. So there's a lot of unique opportunities to build that organic growth that will help fuel the entire platform in its totality, and whether that's for a recap in the future or a sale to a large strategic. But the revenue, it starts to build up, and you get to access more opportunities through those mechanisms. Next slide, Dennis. Perfect. Yeah, and so one of the things is again, going back between in the government contracting industry versus maybe something that's a little bit more commercial, one of the things that we always like to note is that in a commercial transaction, you typically see a lot of asset purchases. And from a legal perspective, that makes a lot of sense. You don't ever want to have buying liabilities. You want to make sure that you're buying only the assets that you want, only the liabilities that are required. And you really take a hard line in those assets and build it into maybe an existing entity. And one of the things that I'll talk about momentarily is the idea these federal government contracts don't really support an asset transaction in the same way. It actually introduces a lot more risk in the transaction in its totality than an equity transaction. And because you're going to do more equity transactions in this space, you tend to have a little bit of a different perspective as it relates to your due diligence, because the liabilities are going to come, in connection with the transaction. So why, right? So we've got this contract novations, change of name packets aspect. And so there's the Federal Anti-Assignment Act, which effectively says if the federal government has issued a contract, and we're just talking about federal prime contracts, not subcontracts, but if the federal government has issued a contract to an entity, then that entity is not allowed to assign that contract to a third party. Certainly the idea being that the federal government did business with you and not with anybody else. And so you need to perform on that contract. And so that's what they determined at the proposal stage to be the best interest of the government. And so you're unable to do that. There is an exception in the federal acquisition regulation called a novation, which you apply to the government and request that the contracts be novated to a successor in interest. You can do so, and it's a very, regulatory dense process. But if you are buying substantially all the assets of a business or substantially all the assets of a line of business, then typically the government will recognize you as successor in interest. But because of this, there is some additional risk, because technically and legally, you have to close the transaction before you apply for novation. So you have to have a legal opinion from your counsel that says that the transaction closed and that the assets were properly transferred in accordance with applicable law prior to them recognizing the actual transfer. So the practical result is that there are certain nuances associated with purchase price. When do we pay it? How much do you pay up front? Do we want to pay more in connection with the closing? We have to have unwind provisions to the extent that it is denied. We have to have, reasonable best effort provisions to make sure that everybody responds to the government's request. Similar to maybe an HSR type provision of hell or high water, we need to be able to do these types of things. And it becomes a little bit of a risk. And so you can avoid that by doing the equity transaction aspect as opposed to an asset. So you can eliminate one risk by doing equity, but in so doing, you bring on the risk of the liabilities associated with the target company itself. And then you've got your government regulatory databases, SAM and DMB. You want to make sure that to the extent you buy a company, that the government will make payments to the bank accounts, to the information that's in these, databases and things along those lines. You want to make sure that you're able to take advantage of that. And of course, in the connection with all of those databases, every time the government is, the company rather, is making certain representations and certifications about its ownership, about its set aside status, about what it is, how it performs, and foreign ownership issues, things along those lines. And you want to make sure that those are accurate. And that's going to be in your transactional considerations for post-closing updates, and it's going to be in your due diligence aspects to make sure that there's no representations or certifications that were made in error, because there is a False Claims Act potential there. And that's just something that is, potentially rather draconian as it relates to liability exposure. Status certification, this goes back to, again, kind of the small business administration aspect, WOSB, SDVOSB, those different types of set-aside status. If a target company is making those representations, you want to make sure that following closing, you can either continue to make that representation, or you have to notify the contracting officer that you no longer qualify as that particular status. And therefore, you may not be able to bid on future opportunities, unless, again, you kind of go through the JV, mentor, protege, and other kind of workarounds to make sure that you can continue to take advantage of that. So that's something to be mindful of as a transactional and as a due diligence. And I think you could say a lot of value is derived from government contracts, but really more value from those full and open contracts. And full and open contracts are contracts that do not have that set aside status. So you could derive, revenue from a small business contract, which is great, but you could derive effectively perhaps the same value from a full and open contract. And that is better because that's future opportunity. That's continue to, recompete and win that contract into the future, even as your company grows. So there's always some nuance about that. And then DCSA change condition packet. This really relates to facility security clearances. For a lot of our clients and a lot of entities that are working in the federal government space, you really do have to have a security clearance, which is tied to certain key management personnel. So think again about your employment agreements. Who do we need to have in our transition services agreement? How do we, make sure that we don't lose in FCL? You cannot buy a security clearance. So see again, asset transactions tend to be limited because you cannot buy a security clearance, but you can obtain one and it stays with the company in an equity transaction. So, and then related to that, you think through exclusionary resolutions where only cleared individuals can see cleared things, which might mean as a private equity sponsor, you buy a company, but you will immediately have to exclude yourselves from looking at the contract or participating in any work or understanding any work associated with that contract. And so it does put a lot of trust on the leadership team that you continue to employ after the transaction. So those are just some of the unique kind of transaction considerations where we differ and kind of diverge from the commercial marketplace. Next slide. And so related to that and kind of tying it together, when thinking about the transaction, when putting it all together and taking a look at the target company, these are some of the diligence issues that we really want to focus on that have liability at the immediate effect, but also have weigh in on our ability to leverage the resources, the assets, and the personnel that we are buying that are resident within the target company. And so we touched upon kind of the facility security clearances and we talked about the FCA considerations. But Catherine, why don't you bring us in and talk about a few of these other things on the diligence front?
Sure, and the diligence issues can be evaluated in great depth. So just to touch on a couple of these at a high level, because they are very unique to the government contracting industry and may not be intuitive for people who don't have a lot of familiarity working within this space. But for example, one thing to keep an eye out for as you're doing diligence on a company is potential organizational conflicts of interest or OCI concerns. Within the federal government space, there is a prohibition on a company being awarded a contract in which it or an affiliate may have the ability to influence the criteria or other components of the contract performance itself and the nature of the contract being awarded. So for example, the government often does outsource evaluation of proposals to contractors who have the requisite knowledge to evaluate proposals for a particular piece of work and help to select the ultimate awardee of that contract. It would be an organizational conflict of interest for a company to be awarded a contract in which it or an affiliate, it also is performing on that selection side of things. So that's a very clear example of what might constitute an OCI. So as you're diligencing a company, you want to look at not only any potential OCIs that may exist within that organization already, but also take into account, in particular for a private equity sponsor that might have a robust portfolio structure, what other affiliates, what other holdings in your broader fund enterprise may already exist and may already have contracts that could, once combined and once affiliated with this entity, create an OCI consideration. So you need to do some internal diligence on your side to evaluate this potential risk, which could compromise the value of the target that you're considering acquiring. Some other things to consider are cost and pricing issues. If you are evaluating a company, or if you are a company looking to sell with a cost reimbursable contract, so that would be a time and materials type contract or cost plus contract, those types of fee structures are subject to audits by the DCAA, the Defense Contract Audit Agency. And DCAA audits can be pretty rigorous. And to the extent there are determinations that pricing has been somehow flawed, or that costs were passed through to the government customer that were not permissible costs, if those come out in audit, the government has a right to retroactively adjust the pricing on the contract, which can result in retroactive price reductions, disallowances of costs. That would, at a minimum, require the contractor, if they still have open audit periods, to refund those amounts to the government. And in extreme cases where it appears that those disallowed costs or improper pricing were done knowingly with the intent to defraud the government, that can result in potential False Claims Act liability, which Dave already mentioned can be a big source of risk. So diligencing a government contractor has its own special features, just like any highly regulated industry. Those are a couple of examples, but definitely something to get smart on and focus on as you venture into this space. And we can move on to the next slide. So we've got about 8 minutes left of time here. And with that time, I'm going to talk a little bit about the concept of affiliation in the context of the Small Business Administration's affiliation rules. This is not what some might think of in a broader like Securities Act, SEC type affiliation. The rules at the Small Business Administration are very specifically related to determining who a company is required to consider as its affiliates for purposes of determining its size under its applicable size standard. Different industry codes are given out depending on the type of work performed by a contractor. They're called NAICS codes, and each of those codes has a threshold, either revenues based or headcount based, above which a company is considered not a small business, and below which you can constitute a small business and be eligible for small business set-aside contracts. A lot of companies work very hard to stay below those size standards so that they can continue to have eligibility for small business set-aside work. It increases their ability to compete with large contractors who are not eligible for those awards, and it can drive up their revenue value. But for a potential acquirer, you need to consider whether affiliation that may result from the transaction could compromise that target's small business status. Affiliation is largely based upon control. Control under the small business affiliation rules comes from either ownership or the ability to influence decision-making at the company. Those are really the two main buckets. Any majority ownership of equity in a company is automatically going to result in affiliation. So if a fund is coming in and acquiring a majority of the outstanding equity interests in a company, they will be deemed to be affiliated with that company. And the affiliation chain doesn't stop at just that direct ownership level. You then need to follow it through and include in that realm all other companies that are affiliated with the parent fund. So if a fund has many different holdings and it owns greater than 50% of the equity or options to receive equity in the future in various other companies, all of those companies' revenues or all of those companies' employees would need to be counted together for purposes of determining size of one of those portfolio holding companies that may be a government contractor. So one thing to consider as a private equity sponsor who may be looking to invest in a company, or as a company that is considering selling to a private equity backed buyer, oftentimes because of portfolio holding company structures, it's unavoidable. The affiliation with the fund and its other holdings may be unavoidable, which often is going to result in the target company post-closing being other than small. It's not necessarily a killer for the deal of a target company that has small business set-aside contracts, but it's important to understand in advance at an early stage of evaluating a company and determining value, what of their contracts are small business set-aside. After the transaction, will the company continue to be small under the small business affiliation rules for that particular contract's size standard? And if the answer is no, you have to evaluate the type of award that contract is, because the company does not necessarily lose that contract and the revenue associated with it. Oftentimes, if it's a single award contract, the company will continue to be able performing it for the entire period of performance. The government customer can no longer take small business set aside credit for that award, but the company will, in most cases, not lose that award. It may compromise their ability to submit a bid on recompete because they then at recompete cannot certify that they are small, but they can see out that existing period of performance. If, on the other hand, the contract is like an IDIQ or a multi-award vehicle where the target company needs to continuously submit bids for new task orders under an umbrella contract, oftentimes they will be prohibited from submitting new bids once they are in an affiliation group that results in them being other than small. So they might be able to continue performing on existing task orders, but not bid for new task orders. Affiliation issues can also have considerations for a target company that has pending proposals for which work has not yet been awarded. But if those proposals were submitted within 180 days of closing of a transaction that results in them being other than small, then they lose eligibility to be awarded that proposal, even though it was submitted when they were still small. So these are all things to take into consideration in pricing a deal and in putting together a strategy for how do you take a company that has small business contracts, and if it will no longer be small due to affiliation post-closing, how do you effectively transition them into a full and open based business model where they can continue to be successful, continue to win awards, continue to compete with larger prime contractors when they lose the benefit of that small business set aside status. So that factors into longer term business strategies and making the case for why a particular acquisition may be advantageous for the long term, even if the small business contracts are no longer there. So it's important to understand the affiliation rules, what can result in affiliation, whether it's the ownership or also the ability to influence decision-making to an impermissible degree, which will also result in affiliation, even if the affiliate does not have a majority ownership of the company. So that's just a very high-level overview. Affiliation rules are very complex and intricate, but something to get smart on if you are evaluating a company with small business contracts. I think that is the end of our slides, and we are right about at time. Thank you very much for attending. I am not sure if we got any questions that we can knock out quickly at this point, but to the extent there are any questions, please don't hesitate to send them through to the email address that was shared, events@mcdonaldhopkins.com, and we would be happy to follow up after this, or you can reach out to any of us directly. All of our personal contact information is on this last slide here. We very much appreciate you attending today, and we hope that you found this useful. Have a great afternoon.